Be ready for significant changes this year, as the potential for a dollar collapse looms. It's crucial to have sufficient gold and silver on hand to navigate the immediate consequences of such an event, which could occur at any moment. My focus lies in the monetary philosophy surrounding these markets. While I grasp the concepts of investment and industrial demand, monetary demand presents a unique perspective that we have yet to fully experience. I differentiate between investment demand, which is what silver enthusiasts engage in by accumulating silver in anticipation of future monetary needs, and monetary demand itself, which arises from the fundamental necessity for money in society. This need for money underpins the division of labor and is far more critical. When we analyze silver futures on platforms like the LBMA or COMEX, we primarily observe prices driven by industrial and some investment demand, but we are not yet witnessing the true price driven by monetary demand. This monetary demand emerges when everyone seeks silver as a medium of exchange for goods, marking a pivotal moment in the market. When the gold-to-silver ratio drops to around 15-1, as it has during past monetary crises, it signals a significant shift in the market. This trend occurs because many individuals find gold too expensive and turn to silver instead, a phenomenon that is already beginning to unfold. Historically, this ratio fell to 15-1 in both 1918 and 1980, and it is poised to do so again amidst a severe monetary crisis. The current situation is not merely about rising prices. It is fundamentally a monetary issue. Basic necessities are increasing in cost at a much faster rate than other goods, indicating that the problem lies within the monetary system itself. While broad inflation figures may capture attention, they fail to reflect the reality of hyperinflation, where essential items soar in price while luxury goods remain relatively stable. As we witness the early signs of a financial crisis, the vulnerabilities of various sectors, such as UK pension plans and cryptocurrency exchanges like FTX, are becoming apparent. This situation is likely to escalate rapidly, prompting central banks to reconsider their strategies. When they do, regardless of the inflation rate, whether it's 5%, 6%, 7%, or 8%, the rush towards precious metals will intensify, as is the natural response of people in times of economic uncertainty. Banks may falter and resume printing money, a scenario that seems inevitable due to immense pressure. When this occurs, I anticipate a significant depletion of silver from centralized stockpiles, including those held by COMEX, LBMA, and various silver funds with unallocated silver in places like the Perth Mint or Switzerland. These stockpiles, despite being different locations, represent the same assets and will likely face simultaneous demand. The pattern is repetitive. Once they are depleted, we, the holders of physical silver, emerge victorious because we are accumulating and not liquidating our assets. A similar situation unfolded in July 2020, when the number of silver deliveries exceeded the registered supply, prompting JP Morgan to transfer around 4 to 5 million ounces from its eligible stock to the registered category. The reasoning behind this move remains unclear, especially since deliveries were flowing into COMEX rather than out. Nevertheless, this incident illustrates the potential consequences of a dwindling registered supply, where a bank might shift eligible silver into the registered category, a tactic previously employed. Historical changes in COMEX rules, particularly in 1980, were enacted because they could, reflecting a time when we were effectively operating under a gold and silver standard. The Federal Reserve's balance sheet was significantly supported by the valuation of gold, which at that time exceeded 100% of the Fed's liabilities, exemplifying the essence of a gold standard. Historically, the gold-silver ratio hovered around 15-1, a standard that has prevailed for centuries. The year 1980 marked a return to a gold and silver standard, allowing the COMEX to manipulate regulations. However, in the current climate, where the Fed cannot feasibly raise interest rates to 20%, any alterations to these rules would likely lead to a surge in demand for physical assets, rendering the COMEX irrelevant. In such a scenario, transactions would shift from paper silver on futures exchanges to direct exchanges of physical silver for goods, creating a decentralized market where tangible coins or reliable certificates would facilitate trade. This shift would signify a return to gold and silver as true forms of currency, contrasting sharply with the untested notion of a currency backed by a basket of commodities, which has never been successfully implemented in history. Gold and silver have always been recognized as money, while commodity baskets fail to hold the same status. There are various schemes proposed to utilize assets like real estate or tobacco as currency, but such alternatives tend to be short-lived. True money is represented by gold and silver, and any new currency formation would need to be backed by these precious metals to effectively replace the dollar. For this transition to occur, countries would need to adopt fiscal responsibility, a trait that nations like Russia, Brazil, and India currently lack. While there is potential for change, I don't foresee a significant shift among BRICS nations towards unity and accountability that would transform the global landscape. Instead, I anticipate that the market will move in a particular direction, with BRICS countries merely following suit and claiming credit for the outcomes. Ultimately, the public will drive market demand, especially as people seek basic necessities like food. Presently, the dollar underpins their purchasing power, but as it declines, there will be a natural gravitation towards gold and silver. The BRICS nations will then have no option but to align with this trend, rather than creating a new market themselves. In terms of timing, I advise being ready for significant changes this year. Ensure you have sufficient gold and silver on hand to navigate immediate challenges. The potential for a dollar collapse looms, and while it could occur at any moment, predicting its timing remains uncertain. This year might be a possibility, but nothing is guaranteed. Many seasoned professionals in the industry, some with decades of experience, have yet to witness the anticipated collapse that many have been expecting. However, it is important to recognize that all inflationary systems follow an exponential trajectory, consistently moving in one direction upward until they reach a critical point. We are currently approaching that vertical phase. Although it is theoretically possible for the system to halt and allow the financial structure to crumble, the greed and short-sightedness of those in power make such a scenario unlikely. When faced with malevolence, one can expect it to persist until it ultimately leads to its own destruction. Presently, the Federal Reserve is attempting to break away from this exponential trend by reducing money supply, but history suggests that such efforts are often reversed. The question remains whether this time will be different, but the likelihood is that it will not. The patterns of the past are likely to repeat, only intensified, and while the exact timing of the impending shift is unknown, it is anticipated to occur soon.